In this video, we're going to talk about the Schwab US Dividend ETF, trading under the ticker symbol SCHD. It's been one of the most popular dividend ETF in the market due to its stable performance and attractive dividend yield. So in this analysis, we will talk about the recent trends, key technical indicators, and the relevance of options in trading SCHD. The daily trading range of SCHD has so far been around $77.07 and a low of $76.65. This narrow range suggests a stable market for the ETF and a daily trend supporting this notion as well. Over the past 5 days, SCHD has experienced a slight increase of 1.5%, indicating a pretty consistent, sideways and yet edging upward type of tendency. The 1-month trend further confirms this with a modest increase of 1.12%, and over the past 6 months, the ETF has rebounded and has shown a notable 2% increase in its value. These trends collectively highlight the stability and the gradual growth that SCHD has been showing in recent times. When considering the options trading for SCHD, it's essential to focus on the key strike prices, and in this case, the options market does indicate a strike price between $77 and $78. These are significant because for call options, it means that there is a notable interest and activity in SCHD within the price range, and the investors definitely should take note on the specific strike prices when considering buying SCHD. The options play a crucial role in trading any sort of equities and ETF because they provide to investors a flexibility and a possibility to manage risk. The calls and put options allow traders to speculate on the future price movements of the underlying asset. In the case of SCHD, the calls with strike prices between $77 and $78 can be seen as a way for investors to capitalize on a potential upward movement of the ETF. Understanding and utilizing the options effectively may enhance a trader's ability to navigate various market conditions. Now, in this case, if many people believe that it's going to reach somewhere around $77 or $78, then it means that the current trend of edging upward will continue on. Now, volume is also another key metric in trading equities, and SCHD's recent volume has been around 4.1 million shares. It is consistent with the average volume as well. The stability in trading volume is a positive sign, indicating a sustained level of investor interest. Volume is crucial because it does reflect the level of activity and liquidity in the market. Higher volume often suggests increased market participation, providing traders with more opportunities to buy or sell at desired prices. Now, the Schwab ETF remains in a strong market position, reflecting a stability amidst a market that lacks clear direction. The sideways movement can be attributed to the ETF's resilience and consistent performance. Considering the recent trends, options activity, and trading volume, I believe that entering SCHD at the current juncture is recommended. It is advisable to allocate around half the capital with the intention of capitalizing on the potential future opportunities as the market develops even further. Investors looking for a stable investment in dividend potentials could find SCHD to be a pretty suitable addition to their portfolios. With that being said, let's broaden our view and examine the larger picture. Throughout the entire year, SCHD has been maintaining a sideways course, finishing just 0.5% higher than the 2023 starting point, and 2024 appears to be following on a similar trajectory, showing minimal change. However, there is a buzz in the air with the anticipation for more substantial movements ahead of us. We're cautiously optimistic, especially given the recent instability in the stock market and also the expected decrease in the interest rates. Also, it's worth considering that holding onto SCHD will not break our bank. With an expense ratio of around 0.06%, it's like having an economical ticket over about like 100 or plus US stocks. Prominent positions like AbbVie, Texas Instruments, and Broadcom are all part of the mix. Essentially, it is an investment in the American economy without the hassle of managing individual stocks. Now, what about the dividends? SCHD has that aspect covered as well. In a scenario where the inflation is making its presence felt, SCHD stands very firm and offers around 4% yield. And here's the kicker, they've been consistently increasing those dividends over time, and this is a very perpetual gift. Now, why is it so popular, especially with the retails? Because it's a preferred choice amongst seasoned investors and everyone else. Like, how can I put it? It had, with expectations of interest rates going down, SCHD might be gearing up for another exciting journey. So definitely stay vigilant as the ETF will navigate through those waters in the upcoming 12 months. Before today's video continues, if you'd like my content and would like to watch more stock analysis videos like this one and so many more, please check out my channel and subscribe for more. So, in a complex world of investing, retail investors often seek opportunities that offer predictable cash flows, high yields, and a safe backbone for their portfolios. SDHD really stands out as a pretty appealing option for retail investors, addressing some common challenges while presenting its unique set of advantages. One of the primary needs for retail investors is the assurance of predictable cash flows. SCHD caters to this requirement by focusing on high-quality dividend-paying stocks. This strategy provides investors with a steady stream of income, a crucial component for those seeking financial stability and regular returns on their investments. High yield is another key aspect that draws retail investors towards certain stocks. SCHD doesn't disappoint in this regard and boasts about 4% yield, which is significant for a dividend ETF. This yield outperforms many traditional financial products, making SCHD an enticing option for investors looking to maximize their returns. For retail investors facing the challenge of limited time of research, SCHD does offer the solution by conducting through stock research that may require time and technical knowledge, something many retail investors lack. Also, being an ETF, it provides instant diversification by holding a basket of dividend-paying stocks. This diversification not only mitigates individual stock risk, but also reduces the need for investors to delve into more detailed and technical search for each underlying company. Another aspect that really shines with SCHD is its cost effectiveness. The ETF charges very low fees, making it an affordable choice for retails. Low fees translate to more of the investment returning back to the investors themselves, enhancing the overall attractiveness of SCHD. It's also essential to acknowledge the challenges, however, that come with investing with SCHD. While the ETF provides a reliable income stream, the exact dividend yield cannot be predicted with certainty. And that uncertainty might be a little bit of a challenge for investors who prefer a more predictable income stream. So, SCHD is already kind of sort of very stable in terms of how much dividend they pay every quarter. However, if you want to be almost absolutely sure, then you can go buy another product such as commercial bonds or that kind of stuff. So, despite those challenges, the diversified holdings of SCHD acts as a buffer, spreading risk across different sectors and companies. That diversification is key in reducing the overall risk associated with the ETF, making it a more resilient choice for retail investors, even in very, very challenging economic environments. Now, essentially, SCHD presents itself as a retail-friendly investment option. It addresses their needs by providing predictable cash flows, a fairly high yield, and a pretty safe presence in any portfolio. The challenges associated with time constraints and lack of technical knowledge are met or at least mitigated by the fact that SCHD has a very diversified holding with very low fees. While the unpredictable nature of the dividend yields and the possibility of an economic downturn are acknowledged challenges, the overall appeal of SCHD. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. Now, having said all this, what is my recommendation for SCHD? Typically, I would recommend gradually building a position over a pretty extended period of time. The potential decrease in interest rates could instill a renewed sense of confidence in a favorable market trend, attracting additional investments towards stocks for potential returns. However, exercising caution is essential, given the currently elevated historical market value of SCHD. Despite the likelihood of fluctuations, SCHD does have the potential to act as a dependable stabilizing force in a portfolio oriented for long-term growth.